we've got exactly what you're talking about. I've got some high probability forex setups for us around some standard deviations and how to trade, when volatility starts to come in, because we've seen some unprecedented volatility in U.S. dollar last month, hitting I think highs since the pandemic, and for some pairs exceeding those highs. I think Swiss franc being one of them. And so here I've pulled a little heat map for you. Standard deviations, and this is just the rolling daily closes, so it gives you an idea of what a daily range will be for each of these pairs. And we've got it over 1 week, 1 month, 3 months, and 6 months. So you can see that 1 month column for all pairs is the most volatile that they've seen. And 1 week, not a lot of data points. I wouldn't necessarily hang my hat on a 1 week standard deviation, but it is worth noting that this past week, 6 trading days, has been very quiet compared to April and March as well. And so you compare this to the 6 month time frame that encompasses all this data, and you start to get a little smoother picture. Do you think that's where we're headed, or could this just be, last week, a really light economic data week. This week, we're expected to pick it up coming into the end of this week with a lot of U.S. data. We've got GDP, we've got, I think, PCE, we've got non-farm payrolls, we've got a BOJ meeting, a FOMC meeting shortly following. So, if there was a week to have a lull, it would have been last week. Do you see us going back to this wild rest of April, or do you think we can point to the 6 month as kind of a benchmark?
I think that we kind of, sure, we've got all of those things on the horizons, known unknowns, in other words, non-farm payrolls, FOMC, BOJ. Markets do get a little tired sometime, and I think we're a little tired right now. So we are holding on to more of the upper end of the range than I would have thought, but sometimes it just takes a while, and then it will release. I don't know. The tariff stuff is still kind of a cluttered mess, but it seems like, from what I read this morning, they're going to make exceptions for certain car parts made in certain places. I don't know.
It's getting more and more vague, but yeah.
Yeah, and at some point it almost seems like, and then he'll lose interest and just kind of walk away from it, and it'll all go away. I don't know.
But yeah, either scenario.
So I think that, we probably revert down to, now you can't say, I still think event risk hasn't changed. They can tweet at any time. We're in price ranges we haven't seen in a long time. Give you that, so the market gets more elastic. I'm going to stick with 90 points of euros, 80 pips of cable. Nothing wrong with that.
Right.
What you're going to do is just get a lot fewer trades, because the market itself is only giving you so much. Now, if that is what you want to do, there's nothing. The one thing is, and this was always hard before we had all these fantastic stats and everything, we would feel our way through these changes in volatility and thus in ranges. And sometimes you'd bring those ranges where you had interest in too tight, too quickly, and the markets would come back out. So I think, for me, wanting to be a little bit more active, I'm going to take a measured approach and start to bring myself back in. Am I coming back into, 6 months of, 45 pips in Aussie, 59 in Euro? I'm probably coming back into, somewhere, and again, this is, so selective. The 27 pips in Aussie is all we've gotten. I'm not coming in. I'm not saying now my new trading range is
aggressive.
30 points.
Yeah.
The width of where we've been is now it's going to be hard to pick the right 30 points.
Right.
Now, what this is saying that, well, then you're going to miss some trades, Pete. Yeah, I'm going to miss some trades because I'm not accepting this. I think that short-dated one just speaks to conversion of vol, not where vol's going to settle. So I will shave off the extremes that we saw in the 1 month and start to work my way back in, where I start to get more trades on the extremes back and forth and work from that.
Yep. And so here we've got the 3 month, kind of the Goldilocks of
Right.
that table, encompassing both the very volatile last month and the not so volatile last week. And so here we've got these ranges, and you touched on it perfectly, that these will just tell you, give you historic context for where these daily price changes closed within 68% of the time, as it is by pair. And so you can use these ranges as guide rails for entry points once a pair has made one of these moves of this magnitude within the time frame that you're looking at, as well as manage your profit or loss targets, which is equally important because even if you're right, you have to be able to pull that off, and setting a profit target too high and unreasonably high can get you in that trade, just kind of waiting for longer than you think. And the same with stop losses. As we both know, things can run away from you quicker than you think. And so making sure you set these can kind of give just some important context around what to expect.
Absolutely. And we go back to our mechanics. So we've got non-farm payrolls coming up on Friday. I'm going to go back to my 3-month numbers. I'm going to add on 25 to 50% of them. Those are going to be my scalping ranges for non-farm payrolls. Just back to like what we've done previously. Things like month end.
Yep.
We've got coming up now. The markets. You would think we've moved so much this month. There'll be huge flows.
Maybe.
Sure. Who knows? I don't know. And some of that may have already been done because markets have moved. But these numbers right there are going to be my rails for probably everything except Kiwi and Aussie, just because I think there may be a little bit more elasticity there.
Right.
But I may miss something. For that 10 to 11 o'clock Central Standard Time frame, when I like to trade month end for FX, I'm going to use exactly those numbers to see if a market gets to that point. I'm going to look to fade that move.
Yeah, and here we have a USD JPY example that was, the highest pip range, but of course we've got really high prices in here as well. And so just wanted to point out that we have around 100 pips that we've noted for the standard
Right.
deviation. And you can take this really a ton of ways because we've had moves greater, if you look at just yesterday, greater than that one standard deviation move running away. And then we've also had, you look at last Wednesday, I think is a great example where, the actual high to low range was greater than that one standard
Right.
deviation move, but does come in. You're also seeing, the day after an inside day. And so you can use these kind of as a momentum or a contrarian trader. Momentum saying, this is one of those days it's not acting like normal. Only 2/3 probability that these stay within these ranges. So identifying which days aren't like the others versus which could be. And my last point I want to make here is because you could be looking at this and saying, Australian dollar, only 55 pips. That's almost half of, what the dollar yen volatility
Right.
is. Is that even worth trading? And so I brought in some key considerations that when you're thinking about just standard deviations, you have to take into account all of the product specs for both of these markets that actually shake out very differently into a US dollar profit and loss. And so here on the table here, we've got, if you had a hypothetical example, if you had $5,000 and you were looking to use all of that on one trade, you look at the margin requirements, Australian dollar requires less to hold.
Right.
And so your max trade size for that would be 2.59 lots at around these current prices. Your dollars per pip are a lot more because you've leveraged up a lot more in that pair compared to dollar yen.
Yep.
And then you factor in what the expected move would be in a day, and this is extremely hypothetical. If you caught all of that range to the profit side or the loss side, you've got more than double the nominal value to your effect to your account trading Australian dollar than yen. So a lot more to consider, right now than than just these ranges, but how these products are actually set up.
I think that's great because that feeds into, and sometimes we don't speak as much about the capital efficiency aspect as we should. But yeah, the different margin rates on the different pairs give you more latitude in terms of the bite you can take. Now, again, choosing a bite that's comfortable for you is critically important. One that you can make unbiased decisions around is great. But this is another great way to think about, well, I'm not trading the big swinging one. It depends on, how you use your capital and what you want to do. This is one of the great things with SpotFX is you can tailor that exposure. And again, larger size is going to create larger returns, but also expose you to larger losses.
Right.
As long as you keep that context in mind and you're comfortable with both those numbers, you're in a great spot.